Hello Pak Yuda, my name is Bram Helianto. I'm from BLEMBA 38 and my student ID is 293251119. Today, I will present about my midterm exam on financial management and policy about the company and bonds valuation. First, I want to declare that I affirm that I will not give or receive any unauthorized help on this exam and that all my work will be my own. In order to calculate the stock valuation, I'm using the free cash flow model. The step one is I will collect all the free cash flow information for the company that is obtained from the financial statement. To calculate the company's stock valuation, I'm using the free cash flow model. Step 1. I'm collecting all the free cash flow information that is obtained from the company's financial statement. In this case, I'm using 5 years of historical data from 2020 until 2024. And the second step is calculating the constant growth for the company. Here, I'm using two different data. The first one is sales growth and the second one is net income growth. So according to the financial statement, we have positive net income throughout these 5 years. So when we are calculating the sales growth and the net income growth, we receive the average 5-year growth is 4.26 of growth from sales and then 5.29% growth from the net income. For myself, I decide to choose growth from net income as the constant growth for the company because net income represents all of the company's performance, not only sales, but also the cost of goods sold as well as the operational effectiveness. Step 3, we will check for the discount rate that applied to the company. Here, I'm using discount rate assumption from the bonds discount rate that is obtained from the penilai harga efek Indonesia. So we are choosing the 5 years of yield to maturity from year 1 until year 5. And then I'm using the longest tenor of the bonds, which is 30 years for the perpetual discount rate. Step 4, we are calculating the present value of free cash flow from year 1 until year 5, and then for the perpetual free cash flow. So when we are calculating the present value of free cash flow, we obtain the free cash flow for year 24, and then we calculate the expected free cash flow growth for 25, 26, 27, and 28. And then we also obtain the perpetual free cash flow for 992 billion. It's the same with the last year of free cash flow. For the present value of cash flow itself, we just using the formula of free cash flow using the discount rate that we have already obtained. And then last one is for the perpetual cash flow. We need to check the perpetual cash flow itself, which is using the last year of free cash flow divided by the growth of the cash flow itself. And then we calculate the present value of the perpetual cash flow, which is 5.6 trillion IDR in here. To calculate the value of the company, we create the total sum of the present value of cash flow. According to this calculation, our present value cash flow of the company is around 9.39 trillion IDR. Step 5, we check if the company have preferred stock and any long-term debt. According to their financial statements, we do not notice any preferred stock or long-term debt for the company. So we check the liabilities and equity section. We do not notice any bank loan or any bonds payable, etc. So indicates no long-term debt. And then when we check to the common stock of the company, we do not notice any preferred stock So basically, it's just common stock, and they also have a sum of treasury shares. Step 6, we calculate the value of the stock. Value of the stock is the total from the value of the company, value of long-term debt, and the value of the preferred stock. In here, since we do not have any value for the long-term debt and the value of the preferred stock, so basically value of the stock is value of the company. We have value of the company 9.39 trillion IDR. Also, we have around 17 billion total shares outstanding. So according to this data, we can calculate that value of the shares is around IDR 549. And when we compare to the share price at 31st December 24, we obtain that the common stock at that time is around 790 IDR. So it means that the company is already overpriced by 241. From my professional perspective, if we check from the number, of course, the ACE stock value is already overpriced. But when we check to the financial statement, their financial statement is stable and healthy. We already checked the current ratio. They have sufficient cash to support the operational. They also have the constant and stable return as represented by return on asset and return on equity. They also have constant growth on revenue and net income. They also already recover from COVID-19 pandemic from year 2020 until 2022. So even though the stock price is already overpriced, but from my professional perspective, I think ACE is still a good company to invest to because they still constantly pay dividends to their shareholder. Also, this company considered is low risk because their financial statement and financial performance is considered healthy. The second task is to calculate the ACE cost of capital. To calculate the ACE cost of capital, I'm using the dividend model. So basically, to calculate the required return of the common stock, I'm using the expected dividend in next year divided by the current common stock plus constant rate growth in dividends. So I already obtained the dividend payment from 2020 until 2024. And then we also have the common stock outstanding available. And we can have the dividend per share. Also, we can calculate the growth of the dividend payment each year. The average growth is around 25.23%. So the expected growth dividend for next year is the last year dividend is 34 added by 25.23%, so we can obtain the dividend payment of 42 IDR per share. So when we are using this formula, we already obtained that the last common stock price per 31st December is IDR 790. And then we also have the dividend payment of 42. So basically, the required return of common stock is just simply the 42 divided by 790 plus the growth rate of 25.23%. So we will obtain the required return of common stock is 30.54%. And then the last task is to calculate the bond valuation. For me, I will do for the problem 2A2. So in here, we have two bonds. The first one is Bumi Serpong Damai, and then the second one is Oki Pulp and Paper Mills. Okay, so we have all of this information from the question, and then we also have the formula using Microsoft Excel rate. Okay, but here I just add some information. The first one is we have listing date and maturity date, so we can obtain the total year in here. And then the second one is total N because the frequency of the coupon payment is quarterly. So it's just simply year times 4. So 7 times 4 equals to 28 and etc. Okay. For the net selling price itself, We also already have the selling price for each bond. For Bumi Serpong Damai is 98% and for Oki Pulp and Paper Mill is 100%. But we have transaction cost, 1% of face value and 3% of face value. So basically, net selling price, both of them is 97%. Okay, we can calculate the interest payment and then we calculate the bond current value today, and we also have the company rating from Pevindo. So from here, I can calculate the yield to maturity for each bond, and it's generate that yield to maturity per year for Bumi Serpong Damai is 7.30%, and yield to maturity for Oki Pulp and Paper Mills is around 8.39%. As investor, we can check for the highest yield of maturity that might be the most profitable investment for us. In here, we can check that the highest yield to maturity is from Oki Pulp and Paper Mills. But if we see the company rating from Pevindo, the Oki Pulp and Paper Mills company rating is slightly lower than Bumi Serpong Damai. So this company is ID A plus, but Bumi Serpong Damai is ID double A. According to this, it means that Oki Pulp and Paper Mills have higher rate of credit risk or default risk. But from my professional perspective, as long as they still have the credit rating above the grade A, let's say A, A plus, double A, or triple A, it means that the company is more stable and safer rather than the company that have rating B, C, or D. So according to the yield of maturity and the company rating itself, my professional judgment is still to purchase the Oki Pulp and Paper Mills compared to the Bumi Serpong Damai.